Chairman, members of the committee, it's a pleasure to be here today. I was just thinking that probably the last time I testified here in Ohio was about 10 years ago, related to the Tax Reform Act of 2005. What I do is tax policy analysis at the state and local level, do studies, and I've worked in over 40 states now, working on the types of issues that you're discussing today in terms of state tax policy changes. I'd like to talk about some of the work we've done for the Ohio Business Roundtable, and it's the memo that has an EY letterhead on it, dated, I believe it's March the 18th. I'd like to step through what we did, and I understand and would expect that you might have some questions about either the methodology or the results, which I'd be glad to address after my comments. What we were asked to do was to look at the package of tax changes that is before you in terms of the various bills. And we started with the revenue estimates by fiscal year that were provided by the Office of Budget and Management. And we took their revenue estimates, which are summarized in Table 1 of the handout on page 2. And we looked at selected components of that package to try to evaluate what effect it would have on business tax competitiveness in Ohio compared to selected other states. As a reminder of what is in the package that we looked at, we have the individual income tax across the board rate reduction of up to 8.5% after a 3-year phase-in, with a top rate of 4.88% on the individual income tax. As you can see from the table, it is, by the time you get to FY17, about a $910 million tax reduction. There are additional tax reductions on the individual income tax side in the package, including the expansion of the earned income tax credit and more generous personal exemptions. The CAT tax increase, tax rate increases in the package, a rate increase from 0.26% to 0.3%, cigarette tax increases, a severance tax, a new severance tax on horizontal wells, and as you can see in Table 1, the proposals as you move from fiscal year 15 through 17 have a slight reduction from $91 million to $23 billion in expected revenue based upon the OBM estimates. But that's the description of the package that we're working on in terms of asking the question, how will these changes affect the competitiveness of Ohio, the business tax system, state business taxes compared to selected other states? Working with Jobs Ohio, looking at what is important currently in Ohio in terms of sectors of the economy, and thinking a little bit about the future and what might be targets for economic expansion in the state, we chose 7 different industries to analyze. Those industries include a mix of manufacturers as well as service companies. What we did to try to isolate the tax changes and their impact on competitiveness is that we created hypothetical examples of the finances, the financial balance sheet, income statements for these hypothetical companies that we created. So we've got a profile of what they look like in terms of income statements and balance sheets. We use that profile, we hold it steady in every state that we look at. We hold the financials constant so we can isolate the differences in the tax systems. Rates, definitions of bases, apportionment of income, all those features that make up a state tax system. The states that we look at include the border states in Ohio, plus some states that are considered to be competitors attracting some Ohio businesses like Tennessee, Georgia, South Carolina. So they're also included in the state comparisons. Well, what we found is that if you look at the state tax component of the package, we're looking at the changes in CAT tax. Our state comparisons include income taxes in the states that have them, franchise taxes, the sales tax on business input purchases. They're all included in the calculation of these, what we call effective tax rates. The effective tax rate is, in simple terms, just the sum of these state taxes on the hypothetical businesses divided by the measure of income. And so they show the percentage of income that's taken up in state tax collections or state tax liabilities. That's our effective tax rate. It's not the statutory marginal tax rate that you would see in a corporate income tax structure. And it's not just the 0.26% current law CAT rate. It incorporates all the definitions and variations on the bases, exemptions, and deductions, sort of the standard features of the state tax systems on businesses. Well, with that comparison, what we find is first summarized in Table 2. So Table 2 looks at just the state tax changes that would be affected by the bill that we're including in our analysis. We're holding the tax systems in all the other states constant. And what we find out is that under current law, Ohio is competitive compared to these other states that we're looking at. And you can see, though, that we list both Ohio proposal and Ohio current law. And generally, what will happen in terms of the state tax increase, which is the CAT tax increase in our analysis, we don't include the cigarette tax in our numbers, so we're looking at basically the CAT tax change in Ohio. And you can see that what it does, it lifts or increases the effective tax rate, this percentage of income that goes to state taxes, by about 0.1%. So, for example, for the motor vehicle parts manufacturing example that we're using, the effective tax rate goes up from 3 to 3.1%. But you do see that there is a slight increase in the overall effective tax rates because of the tax CAT rate increase. But that's not the end of the story, because also included in the package is a significant reduction up to 8.5% after 3 years in the individual income tax that's paid by the taxpayers in Ohio. And so if you move to Table 3, we add this additional dimension. In Table 3, we've expanded our analysis beyond just the entity-level business taxes, such as the CAT tax or corporate income tax in other states. And we've added the individual income tax change in Ohio, the proposed reduction of 8.5% across the board in the rates. To do this, we had to get the income from the entity level of the business to the recipients of the dividends that would be taxed at the individual income tax level. So for purposes of our comparison, we assume that the profits of these hypothetical businesses would be passed along in dividends to the recipients. And then we subjected those dividends to the individual income tax in each state. And when we did that, we get the combined state tax liability on these hypothetical or the example businesses that we're working with. The rates are higher than you saw in Table 2, because we've now added the individual income tax in every state to the entity level business taxes. And you can see what happens here is that when you put the income taxes in, Ohio kind of increases in the relative tax rate compared to some of the other states, because Ohio, despite the tax reductions that have been taking place since 2005, Ohio does have relatively high individual income tax rates. But the table does show that if you compare current law in Ohio with the proposal after the reduction in the individual income tax rates, you do see the improvement in Ohio's competitiveness, their position. You see a lower overall net effective tax rate. Same concept, taxes divided by net income.